All right, so let's continue with bonds. Types of bonds. These are definitions. We'll quickly go through them, but you can just look them over and try to memorize them. Term bonds are bonds. They mature at the same time. So you have more than one. You buy several bonds and they're all going to be due, let's say 3 years on December 31st. Serial bonds, however, are a bunch of bonds you buy and they're due at intervals. So one will be due in year 1 at December 31st. Some more will be due in year 2 at December 31st. They're staggered, right? Secured bonds are bonds that give the bond holders that if you don't get your money, you have the right to an asset. So they're backed by some sort of collateral. And debentures. These are unsecured bonds backed only by the creditworthiness of the bond issuer. So anyone who's looked or researched bonds, you know there are bond ratings out there for corporations and things like that. So the higher the rating, the less of a risk you're considered. Okay. Bonds there's a market for bonds. So the prices will fluctuate. Right now, I told you there was a face value. So depending on the market, depending on the company you're buying bonds from, you may pay face value, you may pay below face value, you may pay above face value. All right, so a discount on bonds payable occurs when they issue you bonds and you're paying less than the face value. All right, so you're going to pay less than, let's go with that $1,000 face value most bonds are, you're going to pay under $1,000 for the bond, yet when that bond matures, you're still going to get that $1,000. Versus a premium, which is the opposite. You're going to pay more than $1,000 for that bond. And when they mature, you're only going to get the $1,000. Okay, so we'll look more at this, a discount and premium bonds payable in a little bit. Let's discuss prices for bonds. So this is a very small representation of what you might find in the paper or in online if you're looking up a particular bond. If you can see here, this SMT is our Smart Touch Learning Company. And they're saying they're 9% bonds, right, that will mature in 2021. They've traded 12 of them. The high price was 79.5 and the low price was 78.45 and it was 79.5 at the close. All right. That means if we look at the highest price, 79.5, the highest at that highest time, the highest price, the bonds were sold for $795. That's less than the $1,000 face value. So they say the price is 0.795. You're going to see problems like this, and they're going to give you this a decimal, and you need to multiply this by the face amount in order to get your price. Right, so this particular one was sold at a discount. The lowest price was $78.45, which is 0.7845. So when you're asked to calculate the price and you're given this rate, you just multiply it by the face. This also, obviously, a lower price was sold at a discount as well. Okay, here's some rules of thumb. I'm not sure the appropriate way to say that. Here's some rules of thumb for determining if something should be sold at a discount, or a bond should be sold at a discount or sold at a premium. You have to look at the market rate. The market rate is not necessarily what the rate of the bond is. Okay, so let's say the rate of the bond at Smart Touch Learning is 9%. If the market rate happens to also be 9%, and you could go out there and that's pretty much the rate you're going to earn on anything, then you're going to pay the face value, that $1,000 you're going to pay for that bond. All right, but let's say their Smart Touch Learning is offering 9%, but the market out there is 10%. You could go to some other company, some other investment vehicle and earn 10%. Why would you buy Smart Touch Learning bonds when you could get 10% somewhere else? Well, I'll tell you why you would do it, because they're going to issue it to you at a discount. You can pay less than $1,000 for the bond and still at maturity receive the full $1,000. So that's a little bump to your investment right there. Okay, that's why we do discounts and premiums. How about this? What if it's offering 9% interest, but the market rate is less than that, 8%? Well, they're being, offering a nice rate of interest. Why would they do that? Why would they do that when they know that we can't go anywhere else and earn more than 8%? They would do it because they know you're going to pay more than that face value for the bond. You're going to pay a premium. And so that's why discount and premium situations happen. So this table is really important to understand that. So please go through that and make sure you understand that relationship and that it makes sense to you. All right, so I mentioned that corporations are so powerful because they can raise a lot of money. They can either issue stock or they can issue bonds. So if you are the decision maker in a corporation, how do you determine, well, we're going to issue bonds this time because we need some money for a new plant, and this time we're going to issue stock? How does that situation, or how does that decision come to be? Here's an example. Certainly it's much more complicated than this, but just to see some of the thought process going into the comparison of issuing bonds and issuing stock. Let's say we are, for a new project, we need to raise some money, right? $500,000. Well, before we do the new project, our net income is $300,000. We can either, plan one, issue 10% bond payable and raise $500,000, or plan two, issue common stock and raise $500,000, which would be more financially beneficial to us. Well, our net income before we do anything is $300,000. So let's stick with plan one. We're going to go with bonds. Expected income. So we're going to say if we're going to invest $500,000, we expect it to help us generate an annual extra $200,000 each year. So here it is, $200,000. However, if we do this, if we invest in this project by bonds, we have to pay 10% interest to our bondholders. So every year, so 500,000 times 10% is $50,000. That's going to take away from this $200,000 in extra income and leave us with an additional $150,000 in income. All right. In addition to that, we have to pay taxes on the extra income we make. So right now, right here, this says 40%. That is a very old percentage. Our corporate tax rates have come way, way down to help corporations use their money for operations and for growth. So this is outdated, but still you would pay something. All right, so you're going to pay tax on the 150. That equals, if we use the 40% number, that's going to be 60,000 in taxes. So at the end of the day, we're making an extra 90,000. So 390, our original 300, our investment of 500 will give us 390. Now this is annual. So you're going to say, 500,000 is a one-time thing, but every year we'll be making 390. All right. Earnings per share is a calculation we're going to look at in the next chapter, but basically you have your net income over the number of common stock shares you have. That means for each share of common stock, they are earning $3.90. So this is our first scenario. This is our results if we issue bonds. Okay, what if we issue stock? Well, we're going to start with the same 300,000, and we're going to say that by doing the project, we're going to generate another 200,000. With stock, however, you have no interest expense, so you will still have 200,000 before income tax, but we have to pay tax on this amount now. So we'll pay a higher income tax rate of 80. We're going to come out with an extra project net income of 120. This gives us an annual net income amount of 420,000. So if we just compare these amounts, it looks like stock is better. However, so dollar for dollar, this seems better. However, what's really important to a public company, and that is the financial statements and the views of our financial statement users or potential investors. And they're going to look at earnings per share, right? So if we do the same calculation here, 420,000 divided by 150,000 shares, we have more shares here because that's what we issued to get this $500,000. So our denominator goes up, our numerator goes up, but it results in less earnings per share for our shareholders. So this, I lost our, there we go. This is our, the decision that has to be made by management. This is very attractive looking to potential investors, earnings per share of 390 versus earnings per share of 280. Okay, so I think that is where we're going to stop for chapter 12 for now. I'm going to go through the rest of the slides. I encourage you to do so as well. And any further comments I will make on our discussion boards. All right, everyone, take care.